Hi, everyone. We're back. All three of us at the same time. Unbelievable. We have a great show coming up. We got Bryan Maddex going to talk to us about rates and other important things right after this. Greetings. Thank you so much for joining us on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management, private lenders in the Southeast for real estate professionals. If you have a deal you'd like us to look at, go to carolinahardmoney.com and click on the Apply Now tab. If you are a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. Wow.
You will celebrate.
I was trying to take a drink of my water.
I have to say, Bill, that you taking a few days off this week has just really fired you up. That's awesome.
Right.
You remembered everything, and
We even got like the finger points.
I know.
Yeah.
So as I'm finishing, Wendy donates 30 minutes of her time per person each Wednesday. So get on her calendar to talk about real estate. There's the link. It's also going to be in our show notes or questions or comments or whatever those things are called over there. I'm sorry, over there. There.
Wherever they may be.
To the right or underneath your screen, depending on your platform. How's that? I'm finished.
Well, you were good until I messed it up and bragged on you.
Thanks for throwing that in there. So you want to talk about a little bit of breaking news, perhaps?
Sure. Let's get some breaking news out here.
So thanks to mortgage rates coming down a little bit, and Bryan will talk about that, stock prices for home builders, home supplies, that type of thing have all shot up. Appliance companies, all that has gone up quite a bit.
Meaning they're doing better.
Yes.
There's more available.
There's anticipation that more construction, more rehab will take place.
Correct.
Yes.
Yeah. So windows are coming in, appliances are working, all that good stuff.
Let's hope they get to Southwest Florida first.
Yeah.
Mm-hmm.
So according to Zillow,
did you lose your spot?
Right. October was flat. It was, plus 0.1%, which
one
is
basis point. Yeah.
In value.
Yeah.
Listings are still down 23.9%
year over year. Mm-hmm.
So there's two reasons for that. I'm assuming because people don't want to sell their homes because now they're going to have to pay much more for their next house. Plus the payments are going to be higher.
Yeah.
And it's just exacerbating the problem with inventory. That said,
so it's working.
Yeah. That said, Redfin also reported that home prices only rose by 3.2%, which, frankly, since the 50s, that's been the average.
That's normal. Yeah. That's called normal. 17 is not normal.
So we're back to normal.
Woohoo!
Which is a good thing.
All right, what do you have?
We just real quickly just touch on multifamily. Because of the interest rates rising, and multifamily has been such a very robust market for the last couple of years. It's really taking a hit right now. We have more multifamily permits in place than we've had in a while.
Yeah.
We just don't have the starts. So it's a lot of projects standing still right now. I think it's to the tune of like 144,000 projects standing still, which is the highest it's been since, I think, 2009. No, 1990. 1990. Don't check me on that, but I think it's 1990. So we're seeing a slowdown there. And then also coupling with that, we're also seeing and anticipating rents stalling and even decelerating.
Well, they're saying that's already happening. It's down a little over 2% in Austin.
Well, in certain markets
yeah.
you're seeing it. Some markets are still far up. National average, we're still up.
Right.
But there are, Vegas is going down. Austin's going down right now.
All of the
slightly.
left coast.
I think you just like saying left coast.
The left side of the map.
It was already very expensive.
Yeah.
It has to come down.
So-
Yeah.
So what I know, I mentioned this in a call earlier I had with Bryan on it. It's just a lot of guys bringing multifamily deals with pro formas right now of rents, and it's getting beaten up pretty bad
Yeah.
because they're using pro formas based off of the last 12 months, and you can't do that. I mean, we have to adjust those moving forward. So that the starts are getting beaten up, and then also the repositioning and buying of multifamily is getting beaten up a little bit. It'll adjust. Don't worry. Not bad news. It's just news.
Yeah. Well,
Yeah.
and then even the rents on single family, we're seeing that either stagnate, drop maybe a little bit in certain markets and in certain price ranges of rent. I mean, I've got a dear friend that's in one of my masterminds that has a couple of houses, new builds, great rental areas that they're in that, he when he built them, he could have easily gotten to $2,000 to $2,100 a month. And now he's got them out at $1,750 and still doesn't have them filled yet. But
Yeah.
He's getting a lot more showings, dropping them down. So, we're seeing that in single family rental markets as well, where that's dropping or stagnating
Yeah.
at this point.
And if you hear anyone telling you doom and gloom, the market is going nuts, like it's all going down,
They're liars.
not true. So just remember, right now our housing inventory is about a third of what it was in 2008.
Yeah.
And there's still, I think it's slightly below 2% on distressed properties. That is not a volatile, crazy market. Like it's still a good market. So remember that.
Right. And
Again,
commercial's
normal.
still doing
It's normal.
is
Yeah.
still doing pretty well
Yeah.
with multi-tenanted buildings, self-storage. It's not going great guns, but self-storage is, in fact, I just went to a self-storage convention last week in Charlotte, and they were saying that they're still renting and still getting the prices that they were previously getting,
Mhm.
but they're not able to push them to the limit like they were. And that it's really just getting back to normal to where they're actually having to ask for the business instead of it just flowing right
Imagine
in.
that.
So
Yeah.
even they were saying it's just getting a little bit back to normal.
That's good. All right. Speaking of getting back to normal, let's get to the show on the road here. So
Awesome.
Something normal. Let's bring on someone normal.
I thought just normal meant you talking. Oh, okay.
Bryan, welcome to our show. Thank you so much for being a part of it.
Do you not?
Sorry, I didn't know we had an introduction for you.
I get my own intro video. That's great.
That
Thanks
was
for having me
good.
back on. It's always great to watch you guys and to participate. So thanks.
Excellent.
Well, thank you. Next time we'll do an elf yourself introduction for you so you can do a little dance for us.
So, Bryan, for those folks who haven't seen the show before and seen you, just give us a quick little synopsis of what you do.
So I do mainly traditional financing. I'm a mortgage broker or a direct lender for the most part. And we dabble outside of the typical products now. And that's what today I wanted to kind of just go over a little bit of the non-traditional product space because the market is moving. And because application volume in the mortgage world is down to a 25-year low, mortgage companies, a lot of them, if you want to stay relevant, you got to figure out what else is out there? What else can we be talking about? And I love this time of year or this season of, it's rough out there market-wise as far as application volume and purchase volume. But if you're a buyer, this is the best time to buy. You're not competing against so many people, you know? And you mentioned the doom and gloom. I was at a real estate meeting this morning and we were looking at the Union County market in North Carolina. And a year ago, we had 1 month of inventory. Right now, there's 1.7 months of inventory.
Ooh.
That is not doing good.
Freaking out, man.
Not doing good. But if you read a headline, the way that gets spun by CNBC is 60% increase in volume. The market is flooded with inventory, right? Like,
Yeah.
it's, if you watch the mainstream media, they get paid to sell clicks, and
That's
they
right.
got to try to scare you for you to click. They're going to try to spin it. 1.7 months is lower than we had in 2019.
That's right. That's
It's
right.
still a seller's market right now, but sellers don't believe it and buyers don't believe it. So it's a weird time. But if you're a buyer, you're competing a lot less and you're getting the house for a little under list price in most cases. So it's great out there in the marketplace if you're a buyer.
Absolutely.
You know what I think is so cool about your company, though? There's so many huge mortgage companies like yours that are still trying to stay in their little circle. And I'm so impressed with what your company is doing. You guys are going, hey, this circle isn't working or isn't as strong as it was. So, let's think outside that, I was going to say box, but circle and see what else we can tap into. And you guys do such a great job of that. And actually, you started doing that a while back. It isn't something that you just flipped into. You guys have really been working on this for quite some time, and now it's really paying off. It sets you apart.
And that's it exactly. Is we kind of saw that we're going to need this before we needed it, and our goal was to get to 25% of our application volume in non-traditional products, right? So to do that, you have to have non-traditional products to offer.
Right.
In the last week or 2 weeks, I'm working on a 32 unit purchase. I'm working on a mobile home park cash out refinance, and I'm working on a 9-unit apartment complex.
Wow.
6 months ago, I couldn't do any of those.
Yeah.
Right. And so they
Nice.
take time. These things take time to develop and to get relationships and go through compliance and legal. But it's amazing that my company leaders had the foresight to say, the market's going to change. We need to be ready for that change before it changes, so that when it does change, we can be in that space. So I'm blessed to be where I'm at.
Yeah, there's a lot of companies that have gone under recently, and it was because they were a one-trick pony. They only had the one thing to do, and when the one thing, dropped by 60-70%, what do you do?
Yeah.
You can't do anything.
That hurts us too. If we're trying to be in this non-traditional space and you only have one partner, like Sprout, and Sprout is no longer here.
Right.
Well, we wanted to be in this space, and our provider just died. And we got bit. We had some loans that were supposed to fund the next week that Sprout announced their demise. Sorry, can't fund these loans, right? And we're going to see more consolidation in both the mortgage space and the non-traditional space. This market is going to drive some consolidation.
Sure,
Yeah,
absolutely.
I remember that day well back in 2008 when ABC Mortgage walked in after we closed 2 days worth of loans. One was 18 loans. The next day was 20 loans. And they called us Friday afternoon and said, we can't fund any of them.
So sorry.
Oh, it was really not a good thing, but turned out to be a great thing because, everything changed for the better. We had to go through some mud to get there, but everything changed for the better. But one of the things that you do, and I love that you do this personally, and you probably do it with your company too, is you guys follow Barry Habib, a lot of what he talks about. What's the latest that you've heard on his opinion on the rates and what he's seeing in the economy?
So I have a slide that I stole from Barry Habib.
Awesome.
Yeah.
We won't tell you.
Don't tell him. I'm going to give him full credit though, because he made the slide. I'm sure he got the slide from somewhere. Inflation. I'll go to that slide now. Inflation is what drives mortgage rates. The Fed raising rates does not affect mortgage rates directly. Indirectly, usually the Fed raising rates is going to help mortgage rates because the Fed is raising rates in order to drive down inflation, which is what mortgage rates are driven by, is inflation. So if you see this chart, in the very center, you've got October. That's 0.9. So what many people don't know is inflation is a 12-month rolling average. So when you get a new month's worth of data, it's eliminating an old month, right? So if you look at that April in yellow, 0.6, and May, 0.7, those were higher-ish inflation numbers. So this April and May, inflation might have appeared flat because we're getting rid of bigger numbers with maybe some smaller numbers. But if you go to October, and then March is going to be a big one. When you replace that 1.2 with a 0.0 or a 0.2, it's going to make inflation look like in March, oh my goodness, inflation just got solved. October, we just got the October updates. Inflation appeared to be down a little bit for the first time. But if you look at the 3 months prior, they were all tiny, tiny inflation numbers, and October was a very large number. So we had to see March or the October number come off with the new October number to see inflation come down. So people were asking me what's going to happen to rates, and I said they really don't have a chance to start coming down until fourth quarter and first quarter, because that's when we're starting to get some of these big rolling average numbers to fall off to change our averages. And guess what happened? Bill said it. We saw mortgage rates come down a little bit because we got the new October number. It looked like for the first time inflation was softening. Well, guess what? Barry Habib told us this was going to happen with this chart exactly right here. So first quarter, we're going to start getting rid of some big numbers. And at the end of first quarter, we're going to see some massive inflation news. You're going to go on CNBC and it's going to say inflation is finally being solved, right? So we don't have a big chance until March to have a reduction in inflation. So Barry has just been talking about that and staying the course. He talked a lot about demand for housing, the amount of new builds that are happening. You guys just talked about starts that are kind of paused, and that's what's happening for builders. They're a little scared. They're pausing their builds. We're going to have an inventory issue next year. If rates come down a little bit, which this chart says they're going to, because inflation should come down, we're going to see demand spike. Once we get a little calmness in the marketplace, we're going to have a new inventory issue. It's going to be, in my opinion, more like it was the beginning half of this year, and not like it's been this second half of this year.
Right. Very interesting.
Yeah, because once those rates start coming down significantly, people are going to jump off the sidelines and like, this is my chance. So yeah, we're going to see a big spike. I think you and Barry are 100% right on that.
I was talking to a client. She's got 160 grand in equity. She bought in 2020. She bought in 2020. She's got 160 grand. She's living in Indian Land, South Carolina, and she wants to be in Charlotte. So she's thinking, I've got all this equity. Let's take advantage. Let's go buy a new home. She's at like 2.75 on her current rate. She's coming into mid sixes or low sevens. Her payment's going to go up $1,000, even though she can put down a tremendous amount of money. So what is she doing? She's on the sidelines. She's waiting. But once rates come back to normal, right? Rates are on the high side of normal right now. They're not high. They're on the high side of normal. But once they come back down into that normal 4.5 to 5.5, she's going to be listing her house. We'll see the listing spike up because she's going to be buying a house.
Yep.
So is there a big difference between the adjustables and the fixed right now?
So adjustable rates, some banks have them because they have deposits on demand, right? They've got grandma CD money, and that they're not paying much for it. They're paying 2 to 4% for grandma CD money. But the yield curve, the measurement of the 10-year treasury versus the 2-year treasury, it's inverted. Right now, you get a higher rate of return if you do a 2-year investment. That is not normal. Normally, the longer you invest, the better your return is. Right now, a 10-year investment pays you less than a 2-year. So because the yield curve is inverted, there's not a good execution on your adjustable rate mortgages. There are some out there in the jumbo space. Most jumbo products are funded by banks. So there are some jumbo arms out there, and there are some conventional arms in bank world. But there's not really in the mortgage world. We don't have deposits, so we have to borrow. And when we borrow short term, it costs us more than if we borrow long term. So we don't have a way to offer a slightly lower rate with an adjustable rate. But we do have this new thing called buy downs. And buy downs has trended on Google because it's a way to make your rate either permanently better or temporarily better. You can do a 2-1 buy down, which means your first year, your payment's based on a 2% lower rate. Your second year is based on a 1% lower rate. And then the third year and forevermore, it's whatever your locked rate is. So that's become much more popular this year to make housing a little bit more affordable until hopefully we can refinance next year.
And can I assume there's no prepayment penalty on those buy down type mortgages? Or
That's correct. Most mortgages in my space cannot have a prepayment penalty because it goes against the rules that were put into place in 2008 from the
Dodd-Frank stuff.
Yeah,
Okay.
all the Dodd-Frank basically eliminated prepays in my space.
Yeah, I was going to say that there's another definition for buy down too. That's when you went to get another car and you had to get a less expensive type model. So you're buying down the features, but you're still paying more for the car than you did before. That's starting to normalize a little bit now too.
Right. Right.
Well, you know, the prepay is running rampant in the DSCR loan space, the non-QM stuff. So it's affecting investors in a huge way.
Right.
Having those prepay. I don't know anybody that's offering DSCR that doesn't have some sort of 3-2-1 or 5-4-3-2-1.
There's a few of them
in.
that, like, you know, you can buy it down to a 1 year the best I've seen is a 1 year prepay. You can buy it down to, but yeah, most are a 3-2-1 or a 5-4-3-2-1 And I mean,
you want to pay it now or do you want to pay it later? But you're
That's
gonna
right.
pay.
yeah, exactly. I mean,
You're going to pay. It's just
That's
how
right.
you want to pay, now or later. You're going to pick.
Right.
yep. So
Bryan, tell us about some of the products that you're offering.
Yeah, so you had a speaker on a week or two ago that kind of covered some DSCR options, and I am going a little bit deeper with the DSCR, which is debt service coverage ratio loans. So investors know these as investor cash flow loans or no-doc loans, and they're not truly no-doc, but we don't get tax returns, we don't get bank statements, we don't get W-2s at all. We base the qualification on the projected rental income versus the payment, right? So a 1-to-1 ratio means I've got $1 of debt that's being covered by $1 of rent. That's a 1-to-1 ratio. That means you're approved income-wise. Now, there are some credit score requirements, but in the DSCR space, we have seen some changes with these rates going up. It's directly affected. When the Fed raises rates, it directly affects the DSCR space because most of these are funded by institutional money, which is
Right.
it's going to have an impact from the Fed. So as rates have been pushed up by the Fed, the DSCR space has gone up. So we've seen some modifications to guidelines out there, but we've also seen some creativity coming out. And what we've tried to do is expand our box or our circle, Wendy. We tried to what we can offer. So some general guidelines is 1-to-1. That was always the standard rule. But now we have some programs that will let you do less than 1-to-1 ratios, right? So if your rent is mostly covering the mortgage payment, you're going to be okay. Now that's a higher risk, and the way you offset risk is with a higher rate.
Right.
So as you get away from the gold standard of 1-to-1, you're going to get into slightly higher. But man, we're investors. If the numbers work, let's go get the deal, right?
That's right.
Someone else is paying this interest for us, and we want to go out and make money, and money can be made in every market. So now in the DSCR space, we have less than 1-to-1. We have interest only. So if your DSCR ratios aren't quite working, you can go to an interest only payment option that may make that 1-to-1 ratio work. 80% is our best loan to value right now for all the companies that we write with. And there may be some out there that are higher, but most companies have retracted the loan to value as the market has softened, as sales have slowed. People don't want to be caught holding the bag. So we'll still do the deal, but you might have to put a little bit more down. So 80% loan to value is now our best execution. There's also no ratio options. Hey, I don't want to look at this rental projection. I want to use just the asset. So if you put 60, if you put 35 or 30% down, we have a no ratio option now. That didn't exist in my space that I had access to earlier. And a lot of the older companies that we worked with prior to 2020, you had to have like 660 or a 680 credit score for DSCR. We now have some investors that will go down to 575. Again,
Wow.
you have to offset that risk with more down payment and probably a higher rate. You're probably looking in the 12% range right now, which sounds high, but if you're making money, who cares, right? We can
That's
always
right.
refinance to fix the rate. We may pay a penalty if we don't pay it up front, to your point about the prepayment penalties. 625, you can do 25% down now. So there are some opening up of some guidelines. And then there's some interesting tweaks to what we can actually finance. When I first started having access to DSCR loans, which was probably 2013 or 2004, maybe 15, it was always single family. They did not want to get outside of that. But right now we can do it on a manufactured home for an investor. We can do adult care facility or a drug rehab, condo-tels, which are going to be like your resort places that have a check-in desk. Those are considered condo-tels. And then non-warrantable condos, which are condos that maybe have a high concentration of investors that
Right.
Fannie and Freddie won't deal with. We've got some DSCR loans now that can cover those types of properties. So this is expanded recently for what's available to be financed out there.
That's huge.
The fact that you can do manufactured homes for real estate investors, that's big.
Yeah.
On DSCR, and it can be rural. It could be out in the middle of nowhere. You're going to pay
Well,
more
most-
than you have to
Most
pay.
of them are
Most of them are,
anyway.
dude.
You'd be surprised what counts as rural or not rural.
Yeah.
There's a lot of manufactured homes that are not considered rural out there. But
See,
yes,
one
that is something that's new in my world is being able to finance a manufactured home for an investor. I used to turn probably 1 or 2 people down a month. Sorry, we can't do that. Now we can. Now we've got
That's
some
awesome.
banks that the banks, the traditional space is drying up. They've got money they need to lend. So they're
Sure.
getting creative and trying to find ways to place money. Because to a bank, when you make a deposit, that's a debt to the bank. They owe you that money. They need to offset that debt with an asset, which is a loan. To a bank, a loan is an asset. So they need to be lending, and the consumer world is slower than it was. So they've really started to open up what they'll look at.
So somebody needs to tell Dave Ramsey that a loan is an asset, not a
Right.
debt.
Depending on which side of the loan you are on, I
Yeah.
guess. Yeah.
That's right.
So
Well,
I'm sorry. I was just giggling when earlier, if you didn't meet the 1-to-1, there was a program there, but the risk is higher, so the rate's higher. And I'm thinking,
That'll
Yeah,
keep you from meeting the
that-
1-to-1.
That makes sense. I can't afford this, so I'm going to charge you even more.
Yeah.
I had an investor that asked me about doing a interest only option, and the place that we could place it with his scenario, it was going to be about 10.1% on an interest only. And I could do at the time 8.125 on a 30-year fixed. And I'm thinking, yeah, interest only is going to be cheaper. Once we did the math, the 8% fully amortized was a cheaper payment than the 40-year interest only option. So you just got to run the numbers and see,
Yeah.
find the deal, and then figure out what's the best way to finance the deal. But you got to find the deal first.
Yeah.
Yeah.
That's for sure.
And that's one thing investors have to look out for. There could be some balloon type mortgages out there where they're going to have a much lower payment on the front end. And the problem is it's going to balloon, and nobody knows what the future is going to be.
Right.
If you can get a 30-year fixed and things change, you can still refinance. But if you're on some sort of a balloon, there's no guarantee you can get refinanced because you don't know what the future is going to hold.
Right.
So I always, if it makes sense, I always push people to do the longer term loan because they know what they're getting. They know at some point rates will continue to go up and the value of that property should continue to go up as well.
Yeah, and you can when you've got a 30-year, you can plan, right?
Yeah.
When you have a balloon, you can hope.
Yeah.
Exactly.
Yeah.
It goes back. I mean, I always like to say, I like options, not obligations. The 30-year fixed gives you have options now. You don't have to do anything. You have an option. A balloon, you have an obligation. Now you have to figure out what to do.
But it's a risk, and what can you sleep at night with?
Yeah.
What will allow you to close your eyes and have a restful sleep? And it's different for everybody, which is why all these options are out there. So it's great to have those options.
Yeah.
Mhm.
For sure.
Absolutely. Let's throw up your contact info there, Bryan. I think we have a little banner at the bottom, and we have it over in the
Wow.
question area.
We
New
have a
adult dating. Look, everybody gets an
Wait.
opportunity.
Excellent. Excellent.
That is
All
not
right.
my contact info. You don't find that link.
We're setting
There
you
it
up,
is.
Bryan. Look, girls, that's what you're going to get. Adult
So I got to
dating.
make sure my wife does not watch.
I was
this
going to say
podcast.
his wife might have something to say. That is too funny.
There's
I'm
not
looking over
a
at the
best loan out there. There's only best for your situation. So you really
That's
do
exactly
need to
right.
find the deal and then explore the options for financing to see if it's still a deal.
Yeah. Yeah, that's for sure.
You know, we obviously have a bot that's in our chat section. over
Yeah,
there.
it's talking about all kinds of crazy stuff with my sister, and
Nowhere. They already blocked it.
yeah,
It's
I'm hoping everybody can't see that.
I would say you gotta love live TV, but
Yeah.
this is live internet. So.
That's awesome. This has been great, Bryan. Thank you so much for sharing all the stuff that you share with us. Everybody can catch Bryan every Friday morning at 7:30 a.m. on our Sunrisers meeting. Every Friday at 7:30 a.m. on Zoom. You have added so much to that group by being able to get on, and we get to get 10 minutes of you every Friday. It's just awesome. All the stuff you share. So I'm so grateful for that.
And you
It's
can
just
get
great
this
to
link
partner with
as
you
well.
guys and to hang out with good people, right? That's the ultimate goal.
And
Yeah.
Absolutely. And you can get that link along with the dating.
the dating link
over
will
there in
also
our
be in the chat.
Um, thanks again, Bryan.
Yeah,
we appreciate it.
good stuff. Good stuff.
Before we go, I want Wendy is going to be speaking at a few places, and I would like to have Wendy talk about these few scheduled events that you're going
Okay,
to.
so let me try to remember what they are.
Well, I think we have a video to start the first one.
Okay,
start
good.
the first one.
Millionaire panel.
Yeah, that's with the upstate. It's the Greenville Real Estate Investor Association, which is an awesome association. They've always had an incredible education program there. It's just amazing what they do. But it's called the Millionaires Panel, but they let me get on it anyway. I thought that was good. So I'm really excited about that. Good questions that'll be
So
there.
they only brought on people with debt up to $1 million.
That's right. I wouldn't qualify for that either. I'd go over that. But anyway, and then there's a couple other places I know that are coming up. Oh yeah, Invest Her is going to be a Zoom link. We'll have more information on that next week. That'll be a seminar where we're talking about creative financing. And then I think I've got one in there. That's
QuestCon.
right. That's right. QuestCon. And that's going to be on Zoom too. So that, and you get a discount if you use Carolina 15 on that by going to questtrust.com. Quest puts on some great events. It's
They really do. They are.
always worth going to.
As long as we're a guest.
Yeah.
Just kidding. And then Raleigh Tria.
Yeah. Going to speak there on January 12th. I'm really excited about being there. They've got some great people at that REI meeting. And again, talking about creative financing.
Yeah, for those who aren't from the area, that stands for the Greater Triangle
Yeah.
REI Group. And it's because there's like 3 cities
Yeah.
in a row there.
Yeah.
But Raleigh's the main one.
Hence the triangle.
Oh yeah, and then I'm speaking at Inside Self Storage Expo in Las Vegas in April.
Yeah.
So I'm a newbie talking to other newbies.
And just to point out, creative financing is something Wendy has done 20 years.
Yes.
20 years.
Mhm.
It's just now everyone's like, oh, we need to do creative financing. So you get to tap into 20 years of knowledge of someone who's been doing it that long with everyone else who's just now jumping on.
That's right.
Excellent.
That's right.
Folks, thank you so much for joining us on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management private lenders for real estate professionals. If you'd like us to take a look at one of your projects, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, we have a place for you. Go to the Accredited Investor tab and click that on. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. We'll see you next week.
Thank you.
Hey.